If the US market were a city, the Dow Jones would be the historic center, the Nasdaq would be the startup neighborhood, and the S&P 500 the entire map. All right, do you agree with this analogy? My name's Chad. I'm the presenter at Zero Markets, and as our own specialists say, every strategic investor needs to answer this question: which of these indices really matter for understanding the market? Today, we're going way beyond popular names in the financial world. We're going to understand the role of each index and how smart American investors use them in practice. In the United States, an index is just a thermometer. It's a cultural reference. The average American doesn't ask, how did the market do? They ask, did the S&P go up? Did the Nasdaq take a hit? Did the Dow hold steady? Each index tells a different story about the economy, the risk, and the behavior. As obvious as it may seem to some people, the strategic investor knows there's no better index. There's the right index for each reading. Let's break it down. The Dow Jones represents giant established companies, leaders in their sectors, and above all, stability, tradition. It's the index that conservative investors watch, traditional media uses, and something that reflects institutional confidence, not innovation. When the Dow performs well, the message is very clear. The big gears of the economy are still turning. In American behavior, the Dow is the establishment index. Tell me in the comments if you know what that means. Now, if not, we'll bring an exclusive video on that really soon. Now, the Nasdaq, it represents growth, risk, and the future. The Nasdaq is the emotional opposite of the Dow. It's home to tech companies, to innovation, and to fast growth. It's the index that reacts first to interest rates, to Fed speeches, to changing expectations. When the Nasdaq surges, American investors read it as risk appetite is back. And when it drops, the message is the market is recalculating the future. Finally, but no less important, we have the S&P 500, the real picture of the market. The S&P 500 is not extreme, it's balanced. It brings together 500 of the largest US companies across multiple sectors. That's why it's the most used index by managers, by long-term funds, by strategic investors. Now, in American behavior, the S&P answers the most important question: how is the economy overall? Now, here's the key point for the smart strategic investor, the one who, of course, follows hot content from Zero Markets. Dow rising alone, defensive. Nasdaq leading, growth seeking. S&P steady, healthy market. And you know the most common mistake amateur investors make? Looking at just one index. The strategic investor watches the divergence between them, because that's where the market starts telling the truth about the game. Understanding the main market indices is not about memorizing acronyms. It's about learning to read behavior. And that is what separates pros from juniors. Smart investors use indices as an emotional compass. They understand what each one reveals about risk, about confidence, and about expectation. Does that make sense to you? Now, if yes, like this video and subscribe to Zero Markets. Here, you don't just learn what the market did, you learn why it did it, so you can apply it masterfully to your investments. And we'll see you in the next video.